Will Woodall, Mike Rarey. Hey, Mike.
Hey, Will.
How's the weekend?
It's great.
Yeah.
Yeah.
It's a good PGA Championship.
Yeah, Brooksy.
Yeah.
Brooksy making a comeback.
He's back, he says. So that's his 5th major?
I think so.
That's incredible.
Elite company.
Yeah. And we had quite a week last week in the markets. Let's start off and look at the equity prices because it was a big week for equities once again, or at least growth equities.
Yeah, a big week for a very small portion of the equity market. Large growth equities now up over 19% year to date. And once again, just as we reported last week, just a handful of stocks doing all the heavy lifting for the S&P 500. Pretty much if you go outside of those 8 stocks, mega cap stocks, odds are you haven't made any money year to date.
Right. And I think if you listen to the headlines, there's one, it's sort of polarized. There's one camp that is very much this is the beginnings of a new bull market. Mm-hmm. Fed's going to cut rates. Other people are saying the worst is yet to come.
Yeah.
So let's look at the price action because we're sort of right back where we were in February.
Yeah. If you look at February 2nd, we were right around 4180 on the S&P 500. Mm-hmm. That's approximately where we are today. Similarly above your 50, 100-day, 200-day moving averages. And, you know, fundamentals started to shift the last time we were at these levels in terms of, you know, we had this market rally. The economy was more resilient than expected, you know, through January, data surprising to the upside. And then more rate hikes started to get priced in. And so the good news became bad news, and we sold off and went down to 3,800. So the fear is now this good news, quote unquote, is going to become bad news. And there's been so many Fed speakers, and I haven't heard anybody mention cut without saying no cuts.
Yeah, I mean, even this morning, they were saying 2 more rate hikes would be appropriate for the remainder of this year, which would definitely suggest no rate cuts.
Right.
So we were sort of sitting where we were sitting last time, and we would see sort of the same outcome if we do see any more rate hikes.
Yeah, exactly. If hikes start getting priced in, that would definitely be, that would not be good in terms of where the S&P 500 is.
So you say rate hikes being priced in. Let's look at the fixed income returns because that's sort of what happened last week.
Yeah, effectively what happened was in 1 week, all of the rate cuts that were built into the market for 2023 have gone away. And this is something we've been talking about for a long time, that those rate cuts weren't justified to begin with. And, you know, some of the gains in fixed income that have been experienced this year, the market might give some of those back, and then eventually equities would give back some of their gains. Right. And so fixed income gave back some of their gains.
Yeah, and not unexpectedly. I think as we sort of sit here today, there's this push and pull. The equity market seems to be levitating on fumes, whereas the fixed income market really is sort of suggesting that we might be coming close to a recession.
Yeah, for sure.
So let's look at alts real quick before we get into some other updates.
Within commodities, a broad basket is down over 8% year to date. Year to date, where have you wanted to be? It's pretty much coffee and gold have been the spots. Gold in particular, gold really performing well to start the year, and then around things like the debt limit and what that might mean, gold rallying as well. So not very bullish. If this is the start of a new bull market and an economic recovery, commodities would be behaving much differently. We've actually seen some of the most bearish positioning in terms of energy and gasoline futures contracts that we've ever seen outside of a recession. So commodities, in our view, much more agreeing with what fixed income is saying, which is, hey, things are not okay in terms of economic growth.
Yeah, I mean, I don't know. I haven't looked at natural gas, but it's fallen off the cliff here, down close to 80%. So let's take a look at updates to our framework before we move much further. So liquidity, not much update here.
Liquidity. Over the next 12 months, we expect the money supply to not grow at all. Not very exciting. A very depressed liquidity environment, particularly for growth stocks, which are liquidity sensitive. So this may stop getting worse in terms of rate of change, but 12 months out, we don't expect it to get much better.
And what happens to this liquidity forecast if there are more rate hikes?
If there are more rate hikes, it would continue to get worse. So hoping that's not the case.
And what impact will the debt ceiling deal, once there's a debt ceiling deal, let's hope, what impact will that have on liquidity?
Yeah, great question. So the Treasury general account, the Treasury's bank account at the Fed, when the Treasury draws that down to pay for stuff, what happens is they release that money into the economy, and they don't suck it back in by issuing Treasury bills. It's just a draw of the TGA. The Treasury has been drawing down the TGA. We're down to about 100 billion, which is, about as much as you need for a rainy day. So that's definitely helped in terms of making this liquidity situation feel less bad recently, because the Treasury has been releasing liquidity into the economy. Once there is a debt limit deal, once, if, when, whatever we want to say, the Treasury is going to issue about $1 trillion in new debt, and they're going to rebuild the Treasury general account back up to at least $500 billion. And what that does is it sucks money out of the economy. If the Treasury issues new Treasury bills, somebody has to buy them, and they buy them with cash. So you exchange a Treasury bill for cash. Cash comes out of the economy. That is tightening. That's liquidity tightening, and it's roughly equivalent to 1 to 2 rate hikes, quarter percentage point rate hikes. So it would be great if we get a debt limit deal. It is going to make the liquidity situation worse when it happens.
Yeah, when it happens. So markets typically react to that equity markets by selling off.
Right.
Yeah.
Yeah.
So we got that sort of sitting there, and let's move to bank deposits and the impact that's having on credit. And potentially, credit's a big growth driver of the economy. Without credit, we don't get good economic growth. So let's take a look at the update here.
Deposit flight. So, actually, to set this up, maybe we look at Fed funds futures real quick.
Yeah.
Because we'll talk about how this has changed. So the blue line is what the market thinks the Fed funds rate is, how it's going to evolve through the end of next year. So that first set of annotations is where the Fed funds rate is expected to be at the end of this year. And the blue line is the most recent curve. It's sitting in between the most hawkish curve, which was end of February, which we're at risk of getting back to. If Jim Bullard is correct in his statements and we need 2 more hikes and that happens, then we get back up to the red line. That's not good. And then the green line is sort of the most dovish curve from the height of the banking crisis. If something goes on in the economy where we go back down to the green line, that's also not good.
Right.
So we're at the blue line. And how has this blue line evolved? Well, week over week, you'll see we sit here now, there are basically no cuts priced into 2023. They're all gone. I mean, once we get into 2024, it's pretty rapid cuts.
Right.
But no more cuts. So you say, well, no cuts, that's not good. But also no hikes, that's all right. But it's not. It's not. Every single day that the Fed leaves the Fed funds rate at these levels is not good for what you were just previewing, the banking system.
Right. And so let's dive into that, because the impact on credit creation is starting to show in the real economy.
Right. So on this chart, we're looking at the Fed funds rate in the blue line. That's obviously what the Fed controls. It's at 5 to 5.25. That's also a proxy for what you can get if you park your cash in a money market fund. The green line is U.S. banks' aggregate cost of capital, or cost of funding. So when you give your money to a bank, how much in aggregate are they paying all their depositors? That's savings account yields. That's checking account yields, if those even exist. That's high yield savings accounts. That's certificates of deposit, all that. How much does that cost banks in order to keep that money so they can make loans? And that's very low. It's still at 1%. So, now everybody is keenly aware that if you have a deposit at a bank, if you're going to leave it at that bank, you're pretty much accepting you're going to earn 1% when you could earn 5%, right?
Big delta.
So this puts bankers in a very difficult position. They basically only have a couple options. One is they pay more in order to retain these depositors. They say, yeah, I know you can go get 5% on a money market fund, but hey, keep your money here. I need the deposit. I'm going to pay you 4% on high yield savings, whatever, something to make it worth your while to keep the money at the bank. That seems okay, but the problem with that is now you just ate into banks' profitability. And now the inverted yield curve matters, right? Because now if a bank is paying 4-5% cost of funding for new money coming in, but extending loans at the exact same rate or less than that,
Right.
then why would you do that, right? So it hampers credit creation, slows economic growth, et cetera. And the alternative is you just let the deposits go. You say, all right, I'm not going to pay you 5%. I agree you can get a better rate at a money market fund. Go. And that's been happening.
Yeah. Yeah, so the banks are sort of stuck. They don't have a good outcome here, right?
There are only two ways to fix the situation. Either the Fed cuts the Fed funds rate back down to something near the current cost of funding, something around 1%, which obviously nobody's talking about, especially with inflation running where they're at, or there's just out of thin air a huge deluge of new deposits and that come into the banking system, and depositors are willing to accept 1%, or less.
Yeah.
That's really it. Those are the only two options. And the only way that would happen is if we had a replay of COVID fiscal stimulus, which clearly is not.
It's not going to happen.
The debt ceiling is telling us anything useful. It's that is definitely not coming.
Yeah.
Right?
Yep.
And so as a result, you see the last line, the orange line on this chart. I mean, we've had 9% of GDP come out of the banking system. I mean, in terms of bank deposit flight. And that just means banks have less money to make new loans. And it's going to slow down the credit engine of the economy, and it's going to slow down the economy sooner or later.
And we're starting to see signs of it, but what's the lag effect? Like, how long does it take? Let's say they hold rates where they're at for another 12 months.
Another 12 months. I mean, you would think it would happen in that window. If you look at any indicators of credit conditions and lending conditions and other recession indicators, it would suggest that this is going to filter into the real economy actually very soon. And what does that mean, filter into the real economy? Well, of course, it means unemployment.
Yeah.
That's it, right?
Yeah. Less loans, less businesses starting, less business expanding, less people being hired, et cetera, et cetera, et cetera.
Right.
So we're painting a nice picture here. Let's add to it by adding to our inflation forecast.
Yeah, inflation still high and falling 12 months out. So we're talking about in April 2024, we're suggesting core CPI will be running at 4.11% year over year.
So
12 months from now. Still
above,
twice the Fed's target.
Well above the target.
So that's why you have Jim Bullard come out and say, hey, 2 more hikes might be appropriate. And he's come out as one of the more hawkish
Yeah, he's always
Fed presidents, but also sort of a leading indicator. The Fed has basically followed his statements.
So we've seen inflation forecasts that have inflation coming down faster than this. What's driving that versus our forecast?
Well, if we were to, so our recession probability is baked into our inflation forecast. What's interesting about our recession probability is it's a percentage from 0 to 100, and we bake that in. If we were to put our recession probability at 100%, basically make it a binary indicator, it's either happening or it's not. If we were to put it at 100%, then yeah, inflation would come down a lot quicker.
Faster.
Yeah.
So there are people who are forecasting recession to happen in this period. Economic growth.
Yep, still low and falling, still a very narrow path. The Fed wants this to happen. It may seem not great, but that is exactly what the Fed needs. Very low growth, but positive growth.
Right.
They will take the slowest growth they can muster while avoiding financial instability and avoiding a recession.
Right.
Give me the lowest number possible that does both of those two things, and maybe I can pull off a soft landing.
It's basically as close to zero as possible.
Right.
Yeah. And the risks to the downside outweigh the risks to the upside in terms of growth, right?
Anytime the Fed funds rate is at 5%, the risk to the downside, relative to the neutral rate. Neutral rate's maybe 2.5, 3.
Yeah.
So you're in restrictive territory, very restrictive. The risk to the downside will always sort of outnumber or outweigh the risk to the upside.
And at what level does the Fed say it's time to cut rates? And then what is their path to cut rates? Is it highly dependent on the depth of the economic slowdown?
Well, let's just say, for example, this economic growth forecast plays out. So over the next 12 months, basically no growth. And over the next 12 months, at the end of that 12-month period, inflation's running at 4%. The Fed would not be cutting, right? How could they? I mean, that would also, if this happens in terms of economic growth, that also means very few or no people lost their jobs. So you're sitting there at the end of the 12-month period, inflation's running twice your target, economic growth is still low, you still have to keep the Fed funds rate high because you're not confident you've defeated inflation and you still have the tightest labor market in history almost, right? So, when do they cut? It would have to be when you finally get evidence that things like non-farm payrolls are rolling over and seeing negative. And even then, think about the starting point. You could, if you're hoping for a true pivot and Fed cuts like we saw, in past economic cycles when we weren't dealing with inflation, you're going to be let down because you're probably going to see a situation where, and the market I don't think is prepared for this, where, all right, non-farm payrolls start coming in negative, economic growth is bad, financial markets aren't doing well, maybe the S&P 500 goes back to 3,600, whatever, and the Fed comes out and says we're going to cut 1/4 percentage point. And you say, whoop-de-doo.
Yeah.
Cutting from 5 to 4 3/4?
Yeah.
What is that going to do for us?
Nothing. Yeah.
Right? Because they're trying to walk this line, right? They want to stabilize the situation, but they also don't want to relive the 70s. So it goes back to the situation where the Fed has basically set themselves up to disappoint from here.
Yeah. So let's look at recession update. Not much change here, but some things.
Not much changing. One thing we want to spend some additional time on is one of our indicators is the Conference Board LEI. That's sort of a medium-term indicator. It's been flashing red. We know if we look at our indicators, the financial market, the medium-term, the financial market indicators have basically been green, right? But everything else has been yellow or red, anything related to the economy. So the Conference Board LEI is something we want to go back to. We got the April numbers last week, and it's down 8.7%. over the past 6 months annualized. Now, there are a few things, when we're putting together our recession indicator, we don't just throw anything in there, right? The Conference Board has an incredible track record at predicting turning points in the economic cycle. They follow the exact same criteria in terms of building their model, depth, diffusion, duration of certain indicators that NBER does. And NBER is the one that they're the ones that determine the red lines, right? The red shaded areas. And we are well within recession territory. If you look, this LEI consists of 10 underlying indicators. 9 of them are steeply negative. The only one that's positive is the S&P 500 index. That's literally it. And the only other one, sort of the last one to fall, was in this month's update, weekly initial jobless claims flipped into a negative, into a detractor. And that's really, as we've been saying over and over again, the labor market is the last thing. It's the last thing. And
it's begun.
And you look at initial jobless claims, they've been running at 200,000, and in the past 3 weeks, they've ticked up to something around 250,000. And that may not seem like a lot, and you look at the chart and it's not exciting, but every single time, the 3-month sum of weekly initial jobless claims is up 20% or more from the lows, we've gone into recession. Every time. We're at 19.1% above the recent lows. And it's moving straight up.
Moving straight up, there's a question that came in, I think it was last week. We didn't get to it, but I'll ask now. The level of unemployment, 3.5% roughly. Speak to that relative to the historical level of unemployment, and does the Fed have more room to allow the unemployment rate to go higher?
Well, okay, so that's an interesting thought. I haven't thought about it until right now, so I'm going to think on the fly here.
Nice.
So
That's the way we like it.
the first thing is the economy exists in two states, right? A non-recessionary and a recessionary state. So what causes the economy to move from non-recessionary to recessionary? It's not the levels of things, it's the rate of change.
Yeah.
So we still think something like a SOM rule is very applicable today, right? Where we've been running with extremely low unemployment. That's why retail sales data has been so strong, spending has been so strong, hiring, all this stuff, personal incomes have been so strong. On a rate of change basis, if the unemployment rate increases just a little, that's still going to have the same impact of tipping the economy into that recessionary state where those negative events spiral on one another.
Right.
Another way to say that is the unemployment rate has been this low before, right? And the SOM rule has still applied in those instances. And also, there's no real precedent for, the unemployment rate increased 1%.
Yeah.
And it stopped. And it stopped. That was it.
Yeah, I think that there's such little thought on the rate of change versus the levels. People always look at levels, but it is, to your point, the rate of change is what really matters. And when things change in directional changes that we're seeing, it doesn't matter what the levels are.
Yeah.
You're going to create the same conditions.
Exactly. We don't report GDP.
Yeah.
We report GDP growth.
Right.
Zero GDP growth is horrible. But if you were just looking at the levels, you'd say, we got a lot of GDP and we just kept it. Great.
Yeah.
Whoop-de-doo. No.
Right.
That's not how it works.
All right. Any final thoughts this week that we need to close with?
I've probably
got a lot of Fed
said way too
speakers.
much.
Got a lot of Fed speakers this week. Next week, I don't know if there's much on the docket for.
We've got another.
events.
I mean, the biggest thing we're going to be watching are those initial jobless claims.
Yeah.
Those were very close to any type of tipping point, so that could be very interesting. We get the second estimate on GDP. Obviously, this week it's going to be a lot of debt ceiling stuff. I'm sure everybody's looking forward to hearing all of that. So yeah, it should be a relatively quiet week.
Right. All right, well, thanks for joining us this week. As always, if you have questions, reach out to us directly or contact someone on the private wealth team. Have a great week. We'll see you back here next week.